Options is the leverage. It's like a gear.
And the other big one is time. The more, if you think about time is the one that makes so much sense in terms of price. You're going to pay more for a long dated option than a short dated option, because especially as you get out of the money, because you have more time to cash in essentially, or the insurer has more time that they might have to pay. There's more uncertainty around that time.
The wrong number to put into a wrong formula to get the right price.
So I'm gaining 5, but I'm losing 3. And the question is that a good trade for you? Is that a good trade for your client if it's your client's money? Is that something that is worthwhile? Where do you think the markets are going? Or do you think that there's more risk to the downside in this scenario than there is for an up 30% market? And would your client make this trade? All right, Daniel, how are you today? Today we have an exciting episode. I think we've gotten a lot of questions about, we deal with a lot of risk and scenarios and things like that, like bad things that can happen to your portfolio. And so a lot of questions we get are, what can we do about it? So I think today is a great day to dive into
options, right? Options.
We're going to do options. We're going to do a little bit
day.
of shorts. Yeah, options day, exactly. We're not going to go in depth into options and how to price them and how to do things like that. But I'm going to show you today. We're going to show you today how to use them in your portfolio to, potentially ward off some downside risk. And we're going to keep it very, very simple. We're not going to get complicated. We're not going to get into, sophisticated option strategies. We're just going to show you what it looks like in the context of our of doing crash testing and protecting your portfolio.
And if there's a time you can get downside protection for less, it's got to be now. Nobody wants to sell. Everybody wants to buy. I'm guessing there is some protection out there to be had for very little.
There is, and that's one thing we can talk about a little bit. But I guess we should say welcome to everyone to our video today. We're I'm Yuan Perillo. This is Daniel Satchkoff, and we're doing our videos investing counterpoint, and it's primarily for anyone interested in the markets, interested in portfolios. We are primarily geared for financial advisors, but really anyone that's interested in managing money or managing their own money. Hopefully can learn something from this.
And managing risk.
Absolutely.
All right, let's go.
All right, so let's dive right in. Okay, so we in the past we've talked about a lot of different scenarios, and we're not going to go into one of those scenarios today. But one of these things that is in common with a lot of different scenarios is we're talking about equity market moves, right? We can have different scenarios around China, the pound, currencies, oil, whatever it might be, but ultimately these things are going to have an effect on markets. And because most of our viewers or a lot of our viewers at least are in the US, we're going to show what it looks like to hedge a portfolio with some options. So it's going to be a diversified portfolio, and we're going to hedge it with some options. And I'm also going to show you how to do it with a short ETF. And we're going to talk a little bit about these things because it's really important to understand the difference between, an option and a short ETF position and the pros and cons of each. So first, we're going to deal with two options, a put option and a call option. So put options give you protection on the downside, right? So you have an instrument. I guess we should probably give a little primer on options today, right, Daniel, to kind of say, we do expect that you have some knowledge on these things, but we'll explain it briefly how they work. So an option is the, put option gives you the right to profit when the markets fall. So essentially you would be taking, you'd be buying a put at a certain price. So the S&P right now is about, we're close to 4,000 on the S&P. So you'd be buying a put on the S&P so that if the S&P falls 10%, say, to 3,600, you would start to profit on that fall. So you pay a small premium for that option to profit as things fall. Now an option has a time component. So you'd have a certain time on this protection. Think of it like an insurance premium. You're buying insurance for the year. By the end of that next year, you renew it. That last premium doesn't help you at all. It's kind of the same with option. You buy it for a period of time, and it can be for a month, for a week, for a year, for 2 years. The time is very flexible.
It's a right to sell. It's a right to sell at a certain price.
It's a right to sell at a certain point. Exactly right. So this helps you in downside protection. Now, it's very much similar to doing something short. Like, so essentially, if I have a short ETF on the S&P 500, I can buy the S&P, I can buy that short right now, and I can, sell it when it gets lower and make a profit, because when it goes down, the price of that ETF goes up. It works a little more like just like the normal ETF that you're thinking, except it's inverse. The price of that option of that ETF will go up as prices of the S&P go down. Okay, and we're going to show you what the differences are on these kinds of things. There's a lot of different gammas, a lot of different Greeks, like deltas and gammas, and different things that you really need to understand if you're going to trade in options. And there's a lot more information that we're not giving you today. What we're going to show you is just basically how they work. If you actually want to get in and trade and do some of this stuff, you really are going to have to do a little more homework than what we're showing you here. But I want to show you the effect of what these things can have. You have anything to add to any of that, Daniel? Is that
No, I think that again, it's important that it's like insurance. Think about it like it's insurance, and there's some math involved, and the difference. You'll talk about the difference between shorting and buying a put. Obviously, it's the amount that you are risking.
Yeah.
So, and let's go. Let's see some graphs and see.
Yeah. So let's pull this up on the screen here. On the screen is it's basically just a standard diversified portfolio. It's a little bit different than what the portfolio Daniel has showed you in the past, but it's very similar. If we look at the asset allocation on this, we have let me just put this in percentages here. It's a $10 million portfolio, 50% equity, 38% fixed income, and 5% commodity. Okay, so it's a pretty simple portfolio. And I have actual stocks and bonds in here, along with some ETFs. And the big one that I have in here is this S&P 500 spider. Okay, that's a relatively large position. It's a $10 million portfolio. So we know that this is a 15% position in the portfolio. Okay, so what I want to do is I'm going to add some options to this. Now, I've created a couple portfolios here. These are all the same right now, but we're going to change them. So this is the first portfolio. The diversified portfolio is the portfolio that we're starting with. I'm going to come into this portfolio.
Yeah, I think it's worth mentioning that these bars are different stress tests for those who haven't seen our previous videos.
Yes.
This is a tool that stress tests your portfolio. It's called portfolio crash test, meaning that there are a lot of different stress tests. So you can see the names here, Fed, severe adverse scenario, or 2008 repeat crash, or stagflation. Basically, these bars say how the portfolio will perform in these types of environments.
Exactly. And so what we're going to do is, because we're stress testing in different market environments, we're going to see what the effect of adding this protection is on these portfolios. And so what I want to do here is we're going to come down where I put in some options down here, down below, and we're going to start adding a couple of options here. And I'm going to do one thing, which is a pretty common strategy. You see this is a $10 million portfolio. Well, what I want to do is I want to buy this. Let's say I'll buy if you read this one right here, an S&P 500 put at 3,600. So like I said, we're at about 4,000 on the S&P right now. And this will give us a 10% cushion, and it's going to expire in 1 year, just over a year from now, right? So I want to add plenty of time for protection. So I want to say basically next year, I want to limit my downside a little bit. I at least want to take some of the downside stress out, because I don't like these scenarios, losing 33% in these scenarios, or 25% here on the downside. So I want to add a put option. And let's say I'll start with $100,000. This is a $10 million portfolio, remember. Now, one thing that you'll see happens is that now I'm at, $10,100,000. So I would need to find some place to take that from. I can do that in two ways. I can either take, one of these positions down so that I have enough cash to do that. Or what I'm going to do here is I'm going to sell a call option. So I'm going to sell something. So what that means is I'm giving up some upside. Okay. So I'm going to give up a little bit of this upside at the same exact amount, $100,000. I'm going to sell that upside and generate $100,000 of income, which means my upside is reduced a little bit because I've sold some of that, but I've bought downside protection. Okay. And so
in other words, if S&P 500 goes up above 4,200, which is where you sold, you're not going to profit as much.
I'm not going to
above that.
profit as much. Exactly. I got to pay some of this back essentially.
Yeah. So you're at this point, you're acting as an insurer. You're insuring somebody.
That's right. Exactly. So I bought insurance and I've sold insurance in this case. Now, in another one, we're just going to buy the short. So, and I'll show you how we can do that as well. I don't want to get too into the weeds with every different iteration here, but there's a lot of different iterations. You can see I've loaded a couple different options in here. And so this one is called the Diversified Portfolio with Options, okay? And real quickly, what you can see that happened here is that this crash rating at the top came down, and I'm just going to bring up this comparison to show you. We started here on this one on the left. This is the original portfolio with a 60 crash rating, and 60 is basically a measure of how risky the portfolio is, anywhere from very safe to very aggressive. So conservative to aggressive, and we're probably at like a moderately, anywhere between moderate and moderately aggressive type of portfolio here. So just adding that small bit of option brought the riskiness of this portfolio down a little bit to 55. So just a little bit more moderate than the moderately aggressive. And keep in mind, we're only taking $100,000 out of a $10 million portfolio here. And we've kept it neutral. So we're doing very little to the portfolio. I didn't want to do something that was so dramatic that that it's not realistic. Because one thing that happens is at expiration, these options will have two values. One, it'll be a value positive, or B, it'll be zero. Meaning if the S&P, so I just bought these put options, for example, this protection for $100,000. If the S&P closes here today and it's 10% out of the money, if the S&P closes here today, in 1 year, that option will be worth zero. I won't be able to sell it for anything. Nobody's going to buy that position from me because it won't be worth anything. It's not going to. There's a very small chance that the market would fall 10% right at expiration of next year. Okay, so that's a very important point to know, that it's just like insurance in that case, where if I don't use insurance, I don't get any money back. But if I need the insurance, if markets fall, I will get money from them. So when we look at these situations here of the Fed, severe adverse scenario, for example, we see the original portfolio of a loss of about $3.3 million on a $10 million portfolio. Let me put this into percentage for a moment. So this one's going to lose 33%. In this option portfolio that we were just talking about, we're only going to lose 27%. So keep in mind, I put $100,000 in to a $10 million portfolio, and that is going to generate a 5% protection, 6% protection in the event of a drastic drastic drop in the Fed. We have equity markets falling.
Limit your downside.
So it's really limited the downside with just a relatively small protection here. Now, what else has it done? Well, it's limited my upside too. We talked about that I sold the call to do that. I sold some of the upside, but I'm also going to have this protection be less and less, worth less and less as the markets go up. So when the market goes up 30%, for example, I'm going to lose, about 3% of that upside because of this position. So I'm gaining 5, but I'm losing 3. And the question is that a good trade for you? Is that a good trade for your client if it's your client's money? Is that something that is worthwhile? Where do you think the markets are going? Or do you think that there's more risk to the downside in this scenario than there is for an up 30% market? And would your client make this trade? And again, we can change the position sizes and things like that. But really, this is the question that we're asking. We're asking, what is the cost of that protection, and is it worth it? And the cost is not just in dollars and cents at the time of purchase, but it's also, in this case, in dollars and cents on the upside. Okay. Now, I can do one more thing here with this, just for argument's sake. Okay, so what I'm going to do is I'm going to take this same portfolio, pro rata. I'm going to free up $100,000. And this way, what I can do is I can buy this position right here for the same $100,000 that I bought before, and now I have another $10 million portfolio. And I'm going to save that, and you can see there's a very small difference in the riskiness of this portfolio. Very small difference in the overall risk of it. But if we look at this, we look at the upside, I've gained more upside. I'm not, I'm only losing that 1% that I just put into the option. If this goes all the way up, that option is going to expire worthless, and I would lose that 1%. And I'm not picking up a whole lot on the downside, but I'm picking up a little bit.
But now you're paying out of pocket. You're paying some premium that you don't get subsidized from selling of that call.
Exactly, but I didn't get the income, so I'm not quite picking up as much on the downside either, because I didn't sell the call, which is, I didn't sell the insurance, which would expire worthless, allowing me to keep that $100,000. So I'm gaining a little more on the upside and losing, not quite making as much on the downside, losing a little bit more than I was in the last portfolio. So that's kind of the give and take. If you want to keep your upside, you can keep more of your upside by just buying the position outright, but you don't have as much protection on the downside. Now, I hope that makes sense to everybody.
And if you have questions, please ask below the video. We will answer it, and I can elaborate on anything.
Yeah, this video might be a little more complicated, I think, than some of the other videos. We're not just talking about market events. We're actually talking about things that you can do to protect yourself. And so it gets a little bit more into some details here, but I hope that it's worth it for everyone to listen. The next one that I want to do is this diversified portfolio, the same diversified portfolio with a short S&P. And you can see I'm starting with the same exact portfolio as I began with. But in this one, I have this position down here. This ProShares short S&P 500. Now, in this case, because I'm just buying something, I don't have anything to offset this with. I can't just take that $100,000 and put it in here. I'd have to free up some money here. So this portfolio doesn't have a cash position. So what I would do is put in $9.9 million position, or I could trade just one of them. It's really up to you how you do this. I'm just going to take it pro rata to make the changes as minor as possible. And I'm going to put in the $100,000 short to the S&P 500. The ticker is SH. It's just a short S&P 500. It's traded over the counter. It's very easy to buy. The pro of this one is that it's very simple to buy, but holding these is essentially a cost. If you look at a chart of the SH versus the S&P, you'll see that there's a bit of a premium. Just like we sold insurance on the other side, you're paying for this insurance in this case still. You're still paying for insurance. Somebody has to execute this product. Now, they tend to do a good job of it, of managing this, but you are paying a bit. So your offset will not be perfect as far as what you're getting, especially over a longer time. The longer you have it, the more insurance you're paying. Short periods of time work quite well. Long periods of time, you start to see a spread. So just be careful about that with the short positions here. There's always a premium. So I'm going to save this, and you can see we have a very small reduction in that risk. We do have a little bit. So just the overall riskiness of this portfolio went from a 60 to a 59. It's a very small adjustment. And so when we look at these together, and I'll go back to the percentage here, you can see we're only losing a bit on this upside, because even as the markets go up, that short position is not worthless, right? We're losing money on it as it goes up, but it's not a worthless position. There's still value there. It can still be traded. But the consequence is we're not gaining anywhere near as much on the downside.
What I think you're demonstrating is that when you use options, right? Options is the leverage. It's like a gear. Like you take a gear and you get a lot more leverage with the option. The same amount for $100,000, when you put it into option, it plays like $1 million.
Yeah.
Whereas when you put it into a linear product, there's no gear, no leverage. It doesn't have much of an impact. $100,000 in the context of this portfolio is really nothing.
Yeah, I mean, and again, we'll just bring back the insurance example. You think about life insurance, and you hear commercials for it all the time. You can get, $1 million for, $1,200 a year if you're 40 years old and in good health, right? $1 million for $1,000 or $1,200 is a really good deal for you. They spread that risk out amongst every a lot of different people. But the point is, for you, it's not a whole lot of money. But if something happens to you and your family would get that $1 million. So it's geared. You're paying a very little to get a lot. It's a similar concept. The mechanisms are very different underneath, but it's the same concept. You're buying insurance against a disaster, and people are willing to sell you that insurance because they don't believe that they're going to have to pay it on it. right? So in this case, this is a 50% decline in the S&P 500, and I'm buying this today. The seller is assuming that there's not going to be a 50% decline in the S&P 500. We're not even assuming they can have other protections in place. They're essentially building their book to be able to cope with having to pay you on a 50% decline, just the way an insurance company generally.
Well, with options though, like the other difference that stems from the fact that options are not linear, they're geared. Those who sell you the option, they're actually taking a risk. They have to calculate very closely what they should charge for that option, right? They run the scenarios. It's, in that sense, it is like an insurance product, because there's actuaries, there are quants who will model it. Supposedly, well, and there have been cases where companies went out of business because they sold some options, right? AIG, I think, was one of them.
Yeah.
They had to be bailed out or whatever. Whereas with the short S&P product, they're not really taking a risk. They're just passing it on to you, and they're taking a fee for running that portfolio. As I understand it, right? I don't think they're risking anything. So it is a very big difference. The big thing about option is the leverage. It is the leverage that you apply. It's the asymmetry. But of course, you have to know a little bit about options, because you might be overpaying. That's the danger with options. Like, you can never lose money if you buy an option, right? That is not going to happen. You're not going to lose more than you pay for it. That's just
more than you paid for it. Exactly.
Mathematically. But what you need to understand is that with options, there's a lot more risk to overpay for it, because the people who sell it to you, they're not stupid. They will calculate different scenarios. But what you should, and this is a kind of a normative prescription, if you want to get a put option to protect yourself, you should get it in a time like today, when the consensus is that everything is going up. There's, just people don't want to sell. They just want to buy. They see all kinds of positive trends for the market. That is when you buy an option if you think you need it. You don't buy an option when the market is volatile, because it's going to cost you an arm and a leg.
And I think that's exactly right. One of the main inputs into option prices is a volatility measure. I mean, volatility is a key pricing to option. And if you look at something like the VIX is a traded instrument. It's an index. It's also a traded instrument, but it's an index that's put out, and it's kind of the central unit for pricing options. It's not exactly the VIX. Every tenor has a different a different volatility number that goes in. But there's this thing called the smile or the smirk of options. And what that kind of means is you're generally going to pay a little more protection on the downside than you are for participation on the upside. And there's bid-ask spreads. There's a lot of different things that changes the pricing of that option. Now, when you're right, it wouldn't matter the pennies that you necessarily paid, too much or too little. If the markets do fall 50%, you're going to get that protection. But, really, that bid-ask spread, the option, the volatility that goes into that pricing can really make a big difference on whether or not that price
adds up, especially over time.
Especially over time.
And with the volatility, when you think about volatility of an instrument, this is like, basically kind of the range, the standard deviation, that how it fluctuates. But with the options, what you'll find is that there's this lingo that is specific to options. There's something called implied volatility, where you price an option and you can imply what the volatility is. And then there's this volatility smile, meaning that for different prices, actually implied volatility is different. And that's crazy, because the instrument is the same, right? S&P 500 doesn't change its volatility, just doesn't happen. So why you will hear this term with options, implied volatility? Well, this is not a secret, right? There's actually a really good saying about implied volatility. It's the wrong number to put into a wrong formula to get the right price, right? With options, yes, there are some smart people trading it, but ultimately a lot of the theory is very simplistic for the real world. So people use implied volatility just as a stopgap. It's like, hey, this formula doesn't really work, but let us adjust some other number to make it work, right? So it doesn't fit here. Let us move the volatility over. So when you trade the option, you need to understand that this implied volatility number, essentially, you can think of it as the cost of an option. Even though it's actually, the terminology is that it's volatility, but it's not about volatility. It tells you how much the option costs. Because what happens is, if you look at the pricing of the options, they're using typically like a Black-Scholes model or various types of models like that. There's a pricing model to price these options. However, Black-Scholes model makes some assumptions. And one of the assumptions is that movement of prices is actually independent from tick to tick, meaning that every move in the price doesn't know about the previous move in the price, which if you think about it, if you're in the financial markets, you'll know that it's nonsense because there's serial correlation and all that. It just doesn't work that way because Black-Scholes uses Brownian motion, which is actually comes from behavior of gases. It's like gas molecules. If you put them in a room, they will distribute according to the Brownian motion. So the Black-Scholes formula assumes that the prices are the same way. So, but in the real world, prices are not like that in financial markets. Financial markets do not work according to this math formulas. So, like 2008, for example, according to this formula, it's impossible. It's like, think of it, you're sitting in a room, I'm sitting in the room, Yuan, and there's this, molecules of oxygen. And then what is the probability that all of these molecules happen to go into one corner, leaving me breathless, gasping for air and running after them? It is not possible, right? Just because this Brownian motion. Now, but in financial markets, we see such events all the time. So therefore, when you work with options, there are a few levels. First, you have to understand what Yuan said, how to use it, what it can give you. But once you go into terminology, you need to understand what implied volatility means, that it's a plug number that helps people use kind of a wrong, unusable formula.
And the other big one is time. The more, if you think about time is the one that makes so much sense in terms of price. You're going to pay more for a long dated option than a short dated option because, especially as you get out of the money, because you have more time to cash in essentially, or the insurer has more time that they might have to pay you. There's more uncertainty around that time. So you think about that volatility, regardless Brownian or serial correlations or whatever we might have in terms of the motion, you have a distribution of what that pricing might be. If you just think about VAR, think about what volatility implies. There's a chance the longer you go that the price can fall. If we're talking about a put option, the price can fall enough that insurer will have to pay, and you have to pay a premium for that with the more time.
Insurance, right? You insure a car for 2 years, there's just that much more chance for something to go wrong.
And that's another reason why some of these short term, like if you look at a long VIX position, which is the implied volatility that I just mentioned, that really only works if you're going to buy that for a short. Basically what happens is that volatility will go up. People want more compensation for insurance when there's more volatility, which is why Daniel says, on a day like today when markets are up, volatility is down, you want to potentially buy your insurance on those days because it's going to cost you less, especially if you're doing it out a year where you're going to be like you're kind of indifferent to the exact day that you do it, but the price is more important. You want to do it on a day that volatility is low. Well, volatility also spikes when big down days happen. It tends to spike when big down days happen. So if you're expecting a sell-off in the market, you could do something like buy a VIX position. There are these ETFs that are VIX. But the thing is, the same kind of thing, you would need to hold that for a short term, because if you're holding that for a long term, hoping for that decline, you're essentially paying an insurance premium the longer that you're in it. And so it just kind of bleeds you money when nothing happens, and it only makes you money when that spike happens. So a lot of these instruments, to protect on the downside, come with some very important caveats that many people don't consider when they get into them. I've seen people hold these VIX positions for long periods of time, and it's just a bleed. So you really need to understand what you're getting into and why, and have a plan for these things, whether it's options, ETFs, short ETFs, long ETFs, whatever they might be, long VIX ETFs, I should say. Long S&P ETFs those don't apply. That's just a long position. Those are different. I'm talking about the protection products that are out there. There's always something that you need to understand about them.
Yeah, and the easiest to understand is a plain put option, right?
Yeah,
plain kind of European. There's European American, whether you can exercise it any day and so on. But the plain put option is where, if you're looking, if there is a concern about the downside, you do a stress test like the one we showed you. You see big downside in your client, whatever, they have new circumstances, they don't want to deal with it, or you yourself in your portfolio, you would start by trying a put option.
Yeah. And there's other reasons to do things like this. You don't want to make big trades. You don't want to, you want to keep it for the long term, but you have some fear that over the next, 6, 8, 12 months, that there can be a big sell-off. A put option is a good idea. You know what the premium is. You know what you might be risking. In this case, I think I risked 1% of the portfolio. And so you know what that's going to cost you. You've already priced in that cost. And so what, if the event happens, you would know what that option is going to do for you. Now, there are still decisions to make. Do I sell it? Do I keep it to the end? What do I do with it once I see that it's in the money? But that's for different videos, different topics. That's more into strategy. But I just thought we would touch on today some different ways that you can protect some downside.
Yeah, you can't talk about risk management without covering options. So I think it was a good call. Thank you for watching. Leave comments. Don't forget to subscribe because you'll be notified about the new videos. And we'll see you next week.
Thank you all for watching.